Welcome everyone. Hi, it's Clint Kuhns here from Andersen Business Advisors, and in this video we are going to discuss unlocking free money from the CARES Act. Now, I'm sure you've heard about this by now. Unless you've been living under a rock and you don't pay attention to the news, you know that the government has passed a momentous piece of legislation 2 weeks ago that allows individuals and business owners to gain access to some much needed funds at this most critical time in our lives. What I've seen, though, as a result of this is a ton of misinformation, a lot of confusion, and for many individuals, just complete paralysis because they don't even know where to begin when it comes to accessing the funds that are out there. So what we're going to do is we're going to break it down. I'm going to cover three of the most important aspects of the CARES Act that are available to small business owners and individuals that they can take advantage of to ensure that their needs are being met, their financial needs. So if you have rental income that's no longer coming in, how you can get money to help cover your mortgages, your management fees, your taxes, your insurance. If you have funds that you're sitting on the sidelines right now that you would like to deploy, but you're afraid to gain access to those funds because it could be taxable, I'm going to show you how to do that. And then we're going to talk about how to take advantage of free money from the government to cover yourself if you're self-employed or you pay yourself a W-2. So there's a lot that's baked into this. There's many more aspects as well that are outside the scope of this video. These are the three core concepts that I've been teaching on. I've been interviewed in the New York Times and several other newspapers on the CARES Act and how it applies to small business owners. So I'm going to share that with you in this video. Now, a little bit about Andersen, where we're located. We're a law firm, tax firm as well. It's everything under one house is the way I like to refer to it. We have attorneys, CPAs. We have offices in Las Vegas, Washington State, Wyoming, and Utah. And our approach to planning is really threefold. We look at asset protection, we look at tax planning, and we also look at business planning. You know, with our approach, what we're able to do for a real estate investor is really hone in and create a structure for them that allows them, as I like to say, do more with their investing, that the entities do not hamper them. So many people who get started in real estate investing or may have been investing for years do not realize that their structures can either help or hurt them when it comes to real estate investing. As an avid real estate investor myself with a portfolio of over 100 properties across multiple states, I've experienced this firsthand with my investing over the years and have since modified structures to ensure that when I apply for loans that I am set up the proper way so I can secure funding. And the reason I bring this up is because this is a major component of what we're dealing with the CARES Act right now. We've been assisting individuals to obtain financing through different government programs. And unfortunately for many of these individuals, that business planning component leg of what it is they're doing has not been adequately addressed. And now it's coming to light. You see, you never know what you're going to need until you're in that situation. And I often refer to this when we're talking about business entities and setting them up with the operating agreements. I would rather have it than not need it, than need it and not have it. And unfortunately, a lot of investors that have come to us for assistance have done that. They put themselves into a box. They have not followed proper formalities with their investing. They have not had proper balance sheets, profit and loss statements, tax returns, W-2s, 941s, 940s, W-3s, everything that the government now is asking for that a traditional business would have so you can gain access to these funds. Many people cannot supply it. And so then we have to go back and recreate it, and that just creates unnecessary delays. So that business component is very, very important when you look at everything that you're putting together. And so treating your real estate as a business, it's something that we cannot impress upon you enough as you're going forwards. But today's agenda, that's not what we're going to be talking about. We're going to be talking about the CARES Act and understanding how this applies to you, and decoding the Payroll Protection Plan loan, as well as talking about retirement plans and the EIDLs. So let me start off first by going through the retirement plans, because with retirement plans, this is a quick source of funding. One of the things that we've been talking about during our funding strategy sessions with our clients that we're working with here is we take them through a process, a funding process, where we first establish a need. And if you need immediate access to cash, that you have a you're in a situation right now where you have more bills going out than income coming in, because maybe your tenants aren't paying you rent, like I've experienced already. A month ago, I found myself in a situation with one of my warehouses where the tenant contacted me and explained that he could no longer pay rent for 3 months. And he said, if you try to force me to pay rent, I'm going to have to file bankruptcy. So now I have a payment to the bank of $12,000 a month, and I'm not getting any rental income in from that property. So this is an example that you may find yourself in, if not now, but in the future. And so these are losses that we've incurred. And so if you need money to cover those, what is one opportunity that is available to you that you could fulfill that need during the short term? If you have a retirement plan, that could possibly meet your need. So under the CARES Act, what they've done under Section 2202 is they have changed the IRA distribution rules. And this also applies to 401ks and A's and 457s. What they've allowed individuals to do now is take a distribution from their plan. That is, you can withdraw up to $100,000 from your account, or it can be aggregated over multiple accounts. If you have a Roth IRA, a traditional IRA, a 401k, you can draw it from multiple accounts. And the funds that you pull out of your accounts, okay, will be treated as a perpetual 60-day rollover. What I mean by that is that you will not have to pay those funds back until December 31st of 2023. And so that money that you receive, okay, that is tax-free to you. It's not subject to an early withdrawal penalty. All right, and you won't pay any interest on that money, and you won't pay any income taxes on that money as long as you get it back into your plan by 2023. Now, the purpose of this money is to ensure that you have current funds to meet your needs. That those needs, of course, have to be COVID related. So you're not going to pull money out to go out and buy a piece of property. If they audited you and they ask you why you took out $100,000 and you said it was to invest in real estate, not going to fly. But let me give you another example. Let's assume that you have expenses now that have gone up. Maybe your contractors aren't working on your property, but you have an HML that you have to pay every month. And so those are expenses that are accumulated on you. Your tenants aren't paying. So you have all these management fees, taxes, insurance, all these costs. Well, how are you paying them? Take the money out of your IRA. Don't use your savings. Save onto your savings to use that for your investing and fund these other expenses from your IRA. So if you're audited, they could say, yes, these were COVID related. See, I used these funds for that purpose. But this is a great way to gain access to your retirement plan funds tax-free. Now, whether or not you're going to get audited, that's anyone's guess. Typically, the audits on retirement plans are very, very, very small. You don't see many of these. So do you have to use all $100,000 towards this? Not at all. I mean, you just have to, the reason why you're stating you're pulling the money out, it's for your concern over the national pandemic and how it is affecting you. So that is one option we have, the penalty-free withdrawals for immediate cash. Another option you have is to borrow money from your qualified retirement plan, and that is a 401a, K, 457, 453 defined benefit plans. With these plans that you have with your employer, you can actually borrow out of the plan up to $100,000 or 100% of your vested balance, the lesser thereof. It used to be that it was $50,000 or 50% of your vested balance, the lesser thereof. So let me just give you an example. If you had $80,000 in your 401k, under the prior rule, you could only borrow $40K because that's 50% of your balance. Under the new rule, and keep in mind, unlike the withdrawal rules that are available for the entirety of 2020, this special legislation is only in effect until September 27th of 2020. So under this rule now, the borrowing rules, for the next 6 months, if you take out a loan, you can borrow up to the entire amount, not to exceed $100K. So with that $80,000 account value, I can pull out $80,000. And here's the thing. It is a loan, but I do not need to pay back that loan for 6 years. In fact, all interest payments are deferred. All payments are deferred for 1 year on it. And so then I have a total of 6 years in the aggregate to repay this entire loan. So I've just given you two opportunities here if you understand what we've said. You can borrow up to $100,000 out of qualified retirement plan, and you can take a $100,000 distribution from your IRAs and qualified retirement plans. That is $200,000 that is available per individual. Now, for some of our clients, here's what we've been doing. They have IRAs that are set up. Husband has an IRA, wife has an IRA, they got a couple $100,000 in each. We're setting up a solo 401k. We're rolling their funds into the qualified retirement plan. Then each spouse is taking their $100,000 loan and then a $100,000 distribution as well. So they have taken out of their plan $400,000. So there are options here, and there's other strategies around this as well. If you're not familiar with qualified retirement plans and how you can use one in your own investing, you should become familiar with them because they do open up other avenues of opportunities when it comes to investing because you have access to these funds in ways you may have not learned in the past, especially if you like to invest in syndications. IRAs can create problems for you. Take control of your own funds. Use your own qualified retirement plan. So IRAs, QRPs, great strategy there under Section 2202 of the CARES Act. Look into that. You can gain access to your monies. Now, the other aspect of the CARES Act that is providing relief to individuals is what we refer to as the Economic Injury Disaster Loan, or the EIDL. Now, the EIDL is a loan that is administered by the SBA. And in order to qualify for this, you have to live in an area that's classified as an economic disaster. Guess what? All 50 states now, as a result of COVID-19, are classified as economic disasters. So it doesn't matter where you live, where your properties are located, you're covered. And so what is the EIDL? It's a loan. So you're going to apply to the SBA and you're going to tell them that your life has been affected as a result of this economic disaster. Now, people have asked me, well, Clint, how do I show that my life has been affected as a result of this? Well, simple. Have your costs not gone up? What does it cost to buy toilet paper now? It's double. If you want to buy hand sanitizer on Amazon, it's 100 times what it used to be. You understand what I'm saying? That everything or a lot of things have gone up in price, and so you need money for that. You don't want to go to the grocery store because you're concerned about contracting it. Boom. You have people bring out the groceries to you. That's cost you more money. You have a stay-at-home order. You can't go out. You can't work. Now you've lost money, so you have economic injury. Your tenants aren't paying you rent. There's so much that you can roll into this to show how your life has been affected that would then potentially qualify you for one of these loans. The purpose of the loan is to make sure that you can cover your expenses during this time. And so when we make the application, the way we submit our applications for the EIDL is to maximize the potential damage that we have as a result of this COVID pandemic. And so then what happens with the loan is that you can potentially borrow up to $2 million. That's a lot of money that's available per individual borrower. Doesn't mean you're going to qualify for the full $2 million, okay? Because it is going to be assessed on a case-by-case basis. And so what we have is, let's say you're a real estate investor, and this is really who this loan is the best option for. If you're a real estate investor and you apply for this, you want to aggregate up all of your rent, and then you want to aggregate up all of your expenses associated with all of your properties, such as your management fees, your taxes, your insurance, your mortgage interest, your depreciation, utility costs, all of that stuff. You aggregate that up, and that shows what it costs you to maintain your assets and then what the potential loss is with those loss in rents. And so that number, whatever that is what you would then apply for. Now, these loans are 30-year loans repayable at 3.75%. And if you're a nonprofit, it's only 2.75%. That's a great interest rate for a 30-year loan at this type of money. But it's even better. Under the CARES Act, they waived what used to be referred to as a credit elsewhere clause, which meant this. You could only apply for this loan if you've already attempted to find the loan somewhere else and you couldn't find one. Now it no longer matters. Anyone can apply for the EIDL. And more importantly, if the amount you're looking to borrow is under $200,000 or the amount that you're eligible for because that's your total economic risk of loss, you don't have to give a personal guarantee. And you may not have to give collateral as well. So with these loans, to qualify for them under the CARES Act, it's really only a credit score. You don't have to provide tax returns. Now, whether or not the lenders are going to issue these without someone providing tax returns, is something we're still waiting to see, because the loans themselves, we've made probably 600 applications for our clients, and we're several weeks out before we're going to hear from the SBA, because the SBA has just gotten slammed with people applying for these things. So the Treasury has stepped in as provide the funds, but we still haven't got back we haven't received back any information from the SBA yet on these applications. And so it's a bit of a lengthy process. But if you can gain access to the funds, then you're going to have this very low interest rate loan that will come from the federal government. Again, you got to use it for economic injury. So that would be, if you're a real estate flipper, you have economic injury because you have to pay your hard money lender. I've talked to a lot of real estate investors that have properties where their contractors are no longer coming out. And so they have these carrying costs, but the project isn't moving ahead. So we want to sit there and we want to determine what is our true economic risk of loss, and then make an application for that amount. So this is a great program. Now, on the back side of this, there's also what is referred to as the EIDL Grant. And this is something that attracted a lot of people initially, because in the CARES Act legislation, it stated that each person that applies for an EIDL loan is eligible to receive a $10,000 EIDL grant within 72 hours of the application. Well, no one got $10,000 within 72 hours of the application. And this has been kind of the problem with this whole process, is that they pass this legislation, then they turn it over to the SBA to issue guidelines on how the program is going to be administered. And so what you found over the past several weeks, the SBA keeps coming out with additional guidelines changing how the act that is passed by Congress is to be administered out to the recipients. So what happened with the $10,000 grant? Well, they decided to limit the $10,000 grant money only to those individuals who applied for an EIDL loan that stated they had employees on for their business. And so what they're doing is they're issuing out $1,000 per employee. So if you listed you had 8 employees, then you would receive a grant for $8,000. The best part about a grant, it is completely tax-free. You do not have to pay it back. So if you're an employer and you have employees, you should make an application for the EIDL loan, and make sure you list how many employees you have, and also make an application for that EIDL grant, because that is free money to you to help cover your costs. So the EIDL primarily is going to apply to the real estate investor. When I say primarily apply, it applies to all businesses, but for real estate investors who are passive investors, you have rental real estate, this is the option for you. Now, if you're active, you have an active business and you pay employees, or you're a sole proprietor, then you're definitely going to want to check out the Paycheck Protection Plan loan. This is called the PPP. Now, the PPP, Congress allocated $349 billion to this plan. Now, that money is going fast. And is it going to be replenished? People keep asking me. The answer to that is most assuredly yes, it's going to be. Congress does not want to get crossways, especially in an election year, with individuals who have been harmed and they can't gain access to these funds, because their business, needs this money to keep people employed, to keep their doors open, even during the time when they have the stay-at-home order. And Congress wants to make sure that the money's getting into people's hands that need it, the employees, and they have their insurance or health insurance being covered, and their 401k, and they're not being furloughed or laid off. So in order to administer this type of program, these loans are run through what we refer to as 7A lenders, which are banks. And the way it works is that you apply to the bank, and you make certain certifications that you qualify for this, and then the bank determines whether or not you meet the SBA's guidelines to qualify for this particular PPP loan. Now, the problem with it is that the bank that is issuing the loan is issuing it with their own money. And this is what a lot of people don't understand, is that the bank issues a loan to you, then they go to the SBA to get repaid. So when this first came out, the loan that they were going to issue to individuals was going to be a loan that had a 4% interest rate attached to it, repayable over, I think it was 10 years initially. But then the SBA came out and they changed it. They changed the terms of the loan. So that got the individuals, lenders, somewhat little skittish because now they're told they have to take a loan onto their books that has a 2-year repayment at only 1% interest. So what has happened now is that in this particular program, that what we found is that people who are applying for it are not necessarily obtaining it right away, because the lenders who are administering the loans wants to make sure that the application packet dots the I's, cross the T's, so that they can turn to the SBA and get their money, because they don't want to be on the hook loaning someone money at 1% for 2 years. So that's issue number one. Issue number two, the $49 billion that Congress allocated just to pay the banks to do this work. Banks get paid based on the loan. So larger loans make more money. Smaller loans make less money. Amount of time involved, the same. So if you're a lender and you have 20 people coming in that asking for about $50,000 each, and you have 20 people coming in that are asking for $750,000 each, which 20 you're going to focus on? You're going to focus on the larger ones because they're going to create more money for you. And so this has created a problem in and of itself, that the banks are picking and choosing who they are going to fund. Now, not all banks are doing this, but we've seen it in several of the larger institutions in the way that the loans have been processed, and just from talking to the lenders, because we're working with lenders all over the country, finding the best route for people for their application. So this loan is for individuals who are self-employed or they have W-2 wages that they're paying themselves. Like if you have a corporation, a C Corp or an S Corp, and you have yourself on salary. So you've got to have active income. If you're a real estate professional, real estate agent, broker, you have active income, you file a Schedule C, that would qualify. If you've set up a limited liability company, treated as a partnership, and you have your income on Schedule SE, you would qualify there as well. So this program is designed to compensate you or pay your wages for a period of 2 months after you get the loan, or 8 weeks. And what they want to do with it is to ensure that you keep people on payroll. And so when you go about applying for this loan, you have to figure out what your payroll costs are, because that is important in ultimately determining how much you're eligible for. So in a payroll cost calculation, what they look at right now is any salaries or wages that you've paid to your employees. You yourself, if you're on payroll, you count. If you had paid leave for vacation or sick leave, you can add that in. Healthcare payments and premiums that you're paying on behalf of your employees or yourself through your business, that's includable. 401k contributions, payment of state and local taxes assessed on the compensation, all that gets added in. I mean, there's a lot that goes into this calculation. But here's something that we keep telling people. We understand that you want to gross up this number, because if you can show that your payroll costs are $30,000, you're going to be eligible for more money under this plan. But you also need to verify these numbers. And so I've worked with several individuals who give me a number, but then they can't back it up. And understand, one of the first tenets of lending is credibility, that if you're going to look to borrow money, you have to be credible and you have to be able to support the numbers you're providing. If you contradict yourself or you cannot support the information you're providing to the underwriter, to the lender, then that creates a problem with your credibility and then lessens the likelihood that they're going to work with you, or they'll probably put you to the back of the pile now. So you want to make sure you're applying for stuff that is easily identifiable. Now, this is what's come up for a lot of business owners, is that they haven't kept good books and records. Remember I said focus on the business, the 3 pillars, the 3 legs of the stool: asset protection, tax planning, and business planning. So if you have very poor books and records for 2019, this is going to hurt you in making this application, because we want to make sure that we have the 941s, the W3s, the 940s, 944s, that the bank is going to ask for copies of your tax returns for 2018 or 2019. I mean, and this process has been evolving. They didn't release the CARES Act, sign it into law and say, all right, next week this is what's required. In fact, what's happened is there's been multiple iterations of what the bank lenders have been asking for throughout this process. I was working with Chase, and just over a period of 5 days, I received multiple emails from them where they kept changing the entire process to apply for this PPP loan. Now, in determining your payroll costs, here are things that you don't look at. If you make over $100,000, or any employee of yours that earns over $100,000, you can't count that excess compensation in your calculation, which I'm about to show you what we're doing here. Any tax credits that you took under phase 2 of the stimulus, you can't count that. If you have employees who are not residents of the United States, you can't add their income in. So essentially what we're doing here with the PPP is we're looking at your income, and we're trying to determine an average payroll for the last 12 months. Okay, or maybe you've only been in business for 2 months, and we'll just determine what it was for those 2 months. So if you paid yourself $20,000 between you and your employees over 2 months, then your average payroll is going to be $10,000 a month. So we got to come up with that number. So in this example here, let's say that this business owner, their gross wages for the last 12 months was $150,000 for the business owners and the employees. The health insurance that the business paid on behalf of those employees and the business owner was $12,000. The retirement benefits was $15,000. So you add this up and it comes out to, I messed up there, $177,000. You divide it by 12, you get this number. You take that number, which is your average payroll cost, you multiply it by 2.5, and you have this number here, $36,458. That is the amount you would be eligible for under the PPP loan program. Now, those funds that they issue to you, you need to use those to pay your employees. So the idea here is that you're going to keep everybody on payroll, and you're going to keep paying them their wages, and you're going to do it for 2 weeks. So you use the funds, 75% of the funds have to be used for payroll. And as long as you're doing that, you're meeting the loan guidelines, and that's going to be important because I'll explain it here in a minute. The remaining portion can be used to cover any interest on mortgages, any rent, lease, utilities, things like that you might have in keeping the business open. So those expenses can be captured under that amount, and that's why they gave you the ability to gross it up by a half a time. So the benefits of this program by applying for this money is, first off, the loan is non-recourse, all right? So that means this: you don't have to provide a personal guarantee, you don't have to provide any collateral for it. Also, any payments on the loan that you need to pay it back, it's deferred for 6 months. The interest rate, as I stated earlier, is only 1%, and the term of that loan is 2 years. So what they're doing is they're giving you money to cover 2 months of payroll. And so the loan terms, or the term of this loan begins immediately upon your receipt, and they want you to use that money within the next 8 weeks to cover your payroll costs. And if you do so, and you use the money in that manner, and you can show it if they require you to show it, because you don't have to. All you have to do is certify it. If you can certify back to your lender, hey, I used that money, 75% of the money you gave me for payroll costs, then the loan will be forgiven. Yes, this is what everyone is excited about. The government is paying you and your employees' salary. So if you're a sole proprietor, you're going to get your average wage or your average income from the federal government, because they will pay your salary for 2 months. So this has created some issue planning about when do you take the money. We've talked to a lot of our clients about it, that in taking these funds, if they've already laid off their employees, they'll never meet this 75% test, because they're not going to typically hire them back just for 8 weeks, possibly to lay them back off again. So some people have asked, should they wait? Well, you could wait to make an application for the PPP, but the problem with that is they may run out of money. If Congress doesn't continue to keep that fund flush, then there will be no funds there for you if you wait, because some individuals have told us that, listen, my business, I don't expect to rehire until June. Well, under an ideal scenario, what you should do then is do not apply for the loan until late May, take the money in June, cover your payroll in June and July with those funds. Allow your people, currently your employees, to stay on unemployment until that time. But people are concerned about the money. So if you did delay, you may not gain access to it. So a lot of our clients have elected to apply for it right away. And if they don't hire the people back, they understand it's a loan at 1% that they have to repay in 2 years. So they may use those funds outside of the 8-week period, which if they do, well, then they got to repay them. But think about this. A 2-year loan at 1% interest, that is almost free money. All right. So even if you don't get it forgiven, you still have funds to carry yourself through, which is definitely going to be a transition period once things start to open back up again. So this should be first and foremost on your mind as far as making an application to this. But recall, this only applies to people who have an active business. You have to have active income. That means you file a Schedule C. You file a Schedule SE from your LLC, or you're a W-2 wage earner and you employ people. If you don't have any of those, you're just a real estate investor, then the EIDL is your choice. Questions we get: can I apply for both? Yes, most definitely. You can go for a PPP and an EIDL loan. You're eligible for both. You just can't use the money for the same purpose if you want to get the loan forgiveness. And there's a lot of other details that we could go into as far as this act that can benefit businesses, such as tax credits. That's really outside of this presentation. But I want you to know your options. Now, I talked about a couple of the options. There are several more. If you'd like, we've actually created a breakdown on a diagram of all of the various programs that you can qualify for, and the limitations on those programs and what's required and the benefits that are provided for under them. If you would like that to get a copy of that form that we've set up that covers all of that, if you go to this link right here, aba.link/thinkcares, we have that available for download. If you go right there, you can download it. It goes through the various options that you have available to you in a succinct format that has broken it down in a nice manner that you can look at and know right away, boom, I qualify for this. I can get access here, and I have money that can come at me in this from this program over here. Well, I hope you guys learned something from watching this video, knowing your options that are out there. Please do not become paralyzed. I've talked to too many business owners that are in that situation right now because they don't think there's any help for them, and they think their business is just going to pass in through this, and they're going to either file for bankruptcy or they're going to be out of business. The government is put this in place to help you. You need to now help yourself. Associate with a professional that can help walk you through the process, or you can do it on your own. My name is Clint Coons with Andersen Business Advisors, and I wish you all the very best. Thank you.